Hello ladies and gentlemen, I'm Joseph Novichkov, Senior Trading Manager with GDM. Welcome to today's webinar. Today's topic, ladies and gentlemen, will be exit rules. Speaking of exits, we've already taken care of most of the important part. Basically, this is the final step into taking position and closing it. So basically, so far we've taken into consideration the size of your position. Second of all, we set the appropriate entry levels plus trade filters to create trading rule. And right now, those trades need to be closed. Therefore, we need to take care of the exit rules. First of all, before moving closer to the topic itself, I would like to remind you that speaking of exit rules, it basically depends on the strategy itself that you're using. That's first. Second, there are universal rules of exit that you can use, which are those which I will present to you today. There are various, but three main extremely simple rules of exit, which you can use in every system, any strategy that you might want to use, and of course incorporate it into your trading plan. First of all, let's remind ourselves that we don't make any profit or loss until our trades are running. So having a precise, equified exit method is crucial to generating predictable returns. As we already know that whatever profit or loss we make on the market, we always record our positions. Unfortunately, many many strategies that you might find either gloss over the exit rules completely, or they rely on vague directives such as exit when you reach your profit target. Since those particular strategies don't specify how to calculate a reasonable profit target, this is basically equivalent to say exit when you feel like you've made enough money, which is absolutely ridiculous and is not very helpful at all. Both entry and exit rules can be thought of in terms of how strict they are, hence how easy or difficult they are to achieve. So you might also say that strictness is a measure of how frequently or infrequently the rule conditions occur. Therefore, oscillators, for example, such as RSI values that are closer to the extremes of 0 to 100 are more strict and they're less likely to occur than the values that are in the middle of the range, like value of 50, for example, for the relative strength index. For moving averages, however, it is easier to cross a short duration moving average than a longer duration moving average. Stricter entry rules will be satisfied less frequently than more lenient entry rules, for example, as we have to get back to the previous particular topic so I can remind you all of this. And thus the strategy that relies on the stricter rules will generate fewer trades than a strategy whose entry rules are more easily satisfied. Within a robust strategy, ladies and gentlemen, the reward for fewer trades is generally a higher gain per trade on average, as we mentioned the last time. For example, if we're using a mean reversal strategy that enters on a price drop, for example, there will typically be a bigger bounce from a larger pullback, which hence a stricter exit rule and entry rule, than from a smaller pullback, for example. The strictness of exit rules has little effect on the number of trades generated by the strategy itself. However, just like the entry rules, stricter exit rules typically result in a higher average profit. All right, so why is that? Because stricter exit rules, ladies and gentlemen, tend to keep you in your trades for a longer time, giving the strategy more time to work. That's one thing. For entries, the trade-off is between more trades and higher gains per trade, while from exits, the trade-off is between shorter trade duration and higher gains per trade. I hope that makes sense to you. So let's go deeper into the exit rules themselves, so we can have a look at a few examples here, which I'm not going to list on the chart for you. I'm just going to go through with it. The more easy and, let's say, various known among traders, and those that I'll present to you will be only 3. Easy to comprehend, easy to implement in any system, exit rules, and into your trading plan. It is often said that you could enter a trade at any price level and make it profitable by exiting at appropriate time, correct? While this seems only simple as it's quite true, trade exits are a critical aspect of trading plan, since they ultimately define the successful trade that you make. As such, your exit rules require the same amount of research and testing as your entry rules. So let's define those exit rules of a trade, which outcomes and how can it be included. The first one, which is included into the trading exit rule as well, would be the profit target. The next one would be the stop loss level. Third one would be either a trailing stop or stop and reverse strategy. The final one is one which is mostly used by day traders, the so-called time exit, such as EOD or end of day exit. As with trade entry rules, the type of exit orders that you use should be clearly stated in your trading plan. For example, profit target, exit with a limit order which is set, for example, by 50 pips above or below the entry fill price. This is something that you can use for your fixed size positions, for example, fixed size entry levels, as we mentioned the last time. Also, along with that, you can incorporate the stop loss level, which is exit with a stop order set about 10 pips below or above entry fill price. And if you have any remaining orders, they will have to be canceled to avoid entering, let's say, unintended position. Now, furthermore to that, I would like to focus into getting great exits, which are crucial for a successful trading strategy. And of course, understanding money management is one of the most important factors into the exit rules itself. Let's say most traders will set up a stop and limit to go along with their trade, but some traders will venture to guess. Most traders are spending, let's say, a lot of time trying to figure out where the price will stop and reverse. That means that we need, in this case, to use a traditional stop limit using support and resistance levels. Now, I have chosen here a 30-minute chart time frame for your exits pretty much because it's one of the simplest, let's say, easier to trade charts on a daily base. Very easy to spot supports and resistance levels, as you can see from this level where we at right now on the euro dollar. It's obviously a strong resistance level, which is at this point when it was broken. Now it's trying to break it to the upside again to convert it into a support level. Another resistance level to the upside we see over here, a very strong one. And of course, miners, we can call on these shadows of these candles over here and over here. And of course, speaking of support levels, we have one which is quite strong, as you can see from the group section here of these candles. We have a lot of shadows. If we scroll back, you will see a lot of groups of candlesticks as well on the rear. And of course, there is another support level which is quite strong over here. Now, this is the easiest way to find out where the support and resistance levels. They correspond quite well with the 1 hour chart time frame, as you can see here. We have a lot of good support and resistance levels. Miners you can take as these, or you can just move this one as a better standpoint on the other hand. And of course, there is one which is over here as a support level from our current price. We have 3 levels below and 3 levels above, which of course can act as stop loss levels or take profit levels. Furthermore to that, when we are selling, for example, the pair, if we're talking of the euro-dollar chart, euro-dollar pair that you're seeing in front of you at this moment, we want to look back and, of course, look at the previous candlesticks and look for an obvious swing high, as well as we see over here. This is a minor support and resistance over here, which you can also look for a good support and resistance level, like stop loss and take profit in that case. Moving further, swing high could potentially act as a resistance level, as we spoke, a resistance or a support level in the future. So we would like to set our stop loss reversal several pips above or below that particular level. So if we have, let's go back to that 30-minute chart time frame. Now, if we see pretty much this should be our trigger area to the upside, or the so-called pivot point in this case, where the price is struggling to go above, as well as it's a major resistance level at this point. And if it's overcome with the closing of this time frame, as it's trying to do right now, we could use our take profit over here. That's in about nearly 20 pips of size, and our stop loss level, if we don't want to use this one down here because it's a pretty big one, it's about 40 pips, which is pretty much 2 times the size of it, and we need to use about let's say 10 pips. It should be somewhere around here, this previous shadow, a few pips below it, or somewhere over here, a few pips below this particular price. That should be our stop loss level. However, we have to always take a look somewhere you know, of the swings on the previous candlesticks to see if it doesn't intersect somewhere, and we can see that this one is well above our stop loss level. So we can rest assured that the first thing that is going to happen is to take our profit first, instead our stop loss, and that's only if you're using 2-to-1 reward to risk ratio. However, this is the most common used particular you know, take profit to stop loss ratio, which most of the traders are using. I personally prefer something like let's say 2 times bigger stop loss and 1 time take profit, but it really depends on the case, so I can't advise you to use my method. The first thing you have to think about is the strategy that you are using, whether it actually allows this particular reversed ratio. Let's have a look at the second exit strategy, or second exit possibility rule that you can incorporate. It is the so-called moving average trailing stop. So it has long been known that a moving average can be an effective tool to filter what direction a currency pair has trended. Of course, it is used to trade the trend. The basic idea, ladies and gentlemen, is that we only look for let's say long opportunities when the price is above a moving average, and we only look for short opportunities when the price is below a moving average. But some traders have found that it can be effective to use a moving average as a stop loss. I don't particularly use this in any trade, but this is a very good tool to use it if you are trading on small time frames, like 15-minute chart time frames, 5-minute chart time frames as well. It is very good to use it as well. The idea is that if a moving average is crossed from one side to the other, then the trend is shifting. Of course, we are trend traders, we would want to close out our positions once the shift has occurred. So this is why setting your stop loss based on a moving average could be effective. However, if you use it on a larger time frame, it has to correspond with, let's say, slower moving average. So using small time frame requires larger moving average. Larger time frame requires smaller moving average if you are going to incorporate this particular system to exit. In an example, let's have a look at the intermediate way. So let me clear first this out for you so we can have a better view on this particular exit rule. We will take as an example the 15-minute chart time frame. There we go. We have the euro-dollar chart again. We will use our moving average. There it is. Not the parabolic, I'm sorry. Okay. That was strange. The chart went off. Sorry about that. I'll just give it a second to shift it back on. Get back to the euro-dollar chart. I hope your picture was not disturbed. I'm going to share it one more time so we can establish connection. If you experience any troubles, just let me know. Okay, going to the 15-minute chart. I'm just going to shrink it a bit. Our moving average should be 100 on this time frame. There we go. Using 15-minute chart time frame, we're using the 100 exponential moving average level. This puts our stop loss, let's say, again, if you are going to use the 1 to 2 risk to reward ratio rule, let's say you have entered on a short position on the bounce off of this moving average. That said, let's have an example of, should we take what? Stop loss level of about 80 pips. Okay, 80 pips should be far up there. Let's shrink it a little bit more. Our entry is here. So our stop loss is way over here. You can see the numbers 9 as a candlesticks and 813, that's approximately 81 pips. Or should we take it at 80 pips? That means our take profit limit is set to 1 to 2. That means 2 times 80 is 160 pips over here. Now this about 8 pips away from your take profit, which is not a big deal. When you see the reversal, you can manually execute it. In most cases, in such a way, it is very difficult to hit a take profit, especially when we speak about 15-minute chart time frame. Talking of 80 pips of stop loss and 160 pips of take profit. So therefore, it is less likely the take profit to be hit. So my way is to take that 160 pips, which is way above there, I'm not even going to go it, and take the 80 pips take profit, which is hit only over here in the next few, in the next 1 hour, should we say. I have a take profit, which means that I can keep trading or just let my profits flow for more profits for another 80 pips or another 50 pips by your decision. So it really depends on the strategy that you use, and most of all, the rule has to correspond with the strategy that you use, whether it's going to be valid for your system. But my, should we say, you know, an exit strategy which I like very much, and it corresponds with any strategies that you need to incorporate it to. This would be the volatility-based stop and limit. So I've saved this for the last strategy today, ladies and gentlemen, for a very simple reason. First of all, the last time when we spoke about the combination of 4 indicators, I hope you remember, I will give you those indicators one more time, the 4 types of indicators every Forex trader must know. Those are the trend following tools, a trend confirmation tool, an overbought and oversold tool, and of course, our exit tool. Now, speaking of exit tools, the particular profit-taking or exit tool that we mentioned would be the average true range. And of course, we have it as an indicator already. So let's implement it directly on the chart without losing too much time and see how it works. Again, the ITR or the average true range, so-called, we're using a period of 14. This should be the universal period for any time frame. That's why I've chosen it. Of course, you might want to choose any period that works best for your system. Particularly me, I like the 14 periods because most of my strategies are based on 14 periods or the last 14 candles. This final technique that uses the ATR is designed to measure market volatility by taking the average range between high-low price for the last 14 candles. So it tells you how erratic the market is behaving, and this can be used to set your stop and your limit for each trade. Let's say take profit and stop loss. Simply put, as you can see from the chart here, our entry was over here, well close to the end of the volatility. So basically, this particular example would actually filter this signal, and we will not even take it. We will wait for something bigger, something better. For example, we will take a level which is somewhere in the middle to execute our trades, entries, so-called, which is this one, and of course exit when the price reaches almost its highest, or the volatility reaches its highest, from where we can expect a downturn into volatility or the reversal of this particular movement. And from here, we are generating about 80 pips of profit in a matter of 29 candles, which is on a 15-minute chart. So it's about 1 day, day and a half of trading, and you can generate $800 of profit on one lot traded. Imagine if you're trading with 10 lots or even 100 lots, that's for 1.5 days, and you have a valid signal. First of all, the trend line is actually signaling you that the trend is still valid. You can see how low the volatility becomes here and how flat the market is actually, which means that this particular entry level could be avoided by just seeing how low the volatility is. And this is if your strategy is volatility based or your exit strategy is volatility based, which of course has to correspond once with each other. But this particular exit entry rules with the average true range, you can always count on it because it measures volatility strength, which is extremely simple to implement in any strategy and gives you advantage to find out when the market is exhausted in this particular direction, so you can exit the market. One thing is very important about the ATR. You never take the highest levels or the closest levels as to 0.022, which is the absolute, and the zero level down here. So you don't really take those extremes, meaning from 0 to 100%. You always have to choose something in between, like levels of 0, 15 to 17 or 20, for example, and levels close to 5 or 10 for some more conservative traders. Basically, level of 10 is pretty much your entry, and when you get to 15 to 18 and down to 8 to 5 is pretty much your exit or entry rule. This is something that you can implement, and basically it actually means that you are taking levels something like 20 and 80 on the relative strength index or the stochastic, but in these cases the volatility that they measure is not so sensitive, so they can stay in overbought and oversold conditions for as long as the trend is valid. So basically the ATR is showing you the volatility, and here it actually gets exhausted. So this particular 80 pips of profit is a perfect signal, perfectly executed, perfectly exited. And so-called, so far for your stop losses, obviously, you should always use levels of ATR of the extremums, 0 or 100, or in this case, the 100 level. Simply put, because when the volatility exhausts, it very, very rarely gets up to the top here. It has to be some extreme market condition, like a large announcement from any government organization, or let's say federal open market committee announcements, central banks, so on and so forth, or any government official that can make the market spike like it spikes right now. However, the volatility rises very quickly here because the time frame is very small, but if we shift down to the daily chart, you can still see that the volatility is extremely low, and you can expect a bounce off from this moving average. But in most cases, this moving average for me is better to use the 200 when I implement any other techniques, and I'm not really using it as a stop level rather than continuation and reverse in this case. Well, basically that's all for today's session. Thank you very much for joining us, and of course this is the last session for this month, the last session before I get into a little bit of vacation, and we will continue in about 2 weeks' time. This is the time when you can just review the past webinars, see if there is something that you've missed, and if there are any questions that you want to ask, you can always get back to us directly on our telephones on the website gdmfx.com, or at our email address webinar@gdmfx.com. That's all for today. Thank you very much for joining us. I'll see you in 2 weeks. Bye-bye.